Should you have life insurance in retirement? And if so, what kind? We're going to break that all down today. So here's the benefits of what I'm going to go through with you. The first is trading pennies and nickels for dollars and getting tax-free growth, death benefit to your loved ones tax-free, a stealth long-term care policy, and lawsuit-free creditor protection. But there is downsides to this. The first is it's an expensive new expense. Even if it's cheap in comparison to what you get, it's still an expense you're not ready for how you planned. Also, you may not qualify with your health. So let me get something out of the way. Life insurance is fantastic for people who can afford it, and it's one of the best ways that the richest people in this country and the banks put their money in permanent insurance. Why? Because it's the best way to transfer your wealth in the tax code, as well as knowing the best way to insure yourself for long-term care that has a set fee that's not going to keep going up year over year. Did you know that banks have anywhere from 10 to 30% of their portfolio in permanent insurance? The average is about 28% across banks. So banks know this is a great place to put their money. But what does that mean for you? Should you have it? Not necessarily, because most insurance policies in retirement are not good for a lot of people because they're very expensive relative to your current expenses. But if you can't afford it, it could be fantastic. But if not, you're wasting your time. So let me explain. The policies with real benefits might cost you anywhere from $200 a month to $3,000 a month. Not an exaggeration, $3,000 a month, especially if you want to get coverage for over $1 million, depending on how much coverage you want. And you might be getting anywhere from $100,000 for your death benefit up to $1 million in death benefit. So even though it's cheap from the perspective of investing pennies and nickels to get dollars, it's a new expense. And if you haven't planned for that expense, it may be crippling. So Dave Ramsey gives great advice to young people that are having a hard time paying their bills and starting off, which is to avoid whole life insurance. And that's correct. He says, get term and invest the rest in the market. That's not true when you get older. That's great advice when you're young because you're struggling. You just need to have more money in the market and let it grow. But here's the problem. As you age, you can't get term insurance, or it becomes so expensive, it's literally impossible to even pay for the policy for what you're getting. So he goes too far, in my opinion. He fails to understand that term insurance only pays out 2% of the time. That's it. 2% of the time, it's actually a little fraction under 2%. They don't tell you that part. The only insurance that matters, I repeat this again, the only insurance that matters is the one that pays. Nothing else matters. It has to pay you. Permanent insurance is guaranteed to pay you. That's the most important part to this component of whether or not you need insurance. This is why one of the biggest mistakes people make is that they think of insurance in terms of paying for term and term pricing. But the insurance company policies that are made to last is the only one is whole life because it's a consistent premium, whereas every other policy has massive problems as you age. Only term insurance in retirement doesn't make sense. It's exactly the opposite of when you're young. Whole life makes no sense when you're young and struggling. Don't get whole life when you're young and struggling. It's when you have money and you want to have a wealth transfer vehicle. First, most term policies only go to 65 or 70 years old, as I mentioned before. And then they drop you or they raise the rates so high you have to cancel. Second, term only pays out 2%, as I mentioned before. That's a huge problem. You're forced to drop it when you need it. The other policy is what's called universal life. Universal life, in my opinion, is not a good policy because it's a cross between term and whole life. The cost of insurance goes up constantly as you age because the pricing is unstable. You can't budget around it. And I've seen people have paid in their universal life policies for years and years that became too expensive. Now, whole life alone provides that stable pricing that is permanent. If you pay the premium and you finish paying, there's, for example, what's called a 10-year term, or it's called a 10-pay. There's even what's called a 20-pay or a 20-year term. And then once you've paid into it, you never make another payment again the rest of your life, and you're guaranteed the full death benefit. So here's a great example. You pay in to that benefit, right? You only pay 2 payments and you pass away. Your family still gets the full death benefit. But let's go through each benefit of why this is so important. The first is tax-free income. Any growth in your account that can be taken back as a loan doesn't count as income. Therefore, it's tax-free. A lot of people use it for tax-free growth. I don't think that's the real function for it, but you can definitely use it for that component. Next is the death benefit. Now, this is obvious because when you die, you want your beneficiaries to get paid. Also, you can get it back if you are considered terminal. I'll go through that in just 1 second. Third is creditor protection. There's creditor protection in life insurance, which is only covered by only a few things that the cash in there can never be touched. That's only in life insurance and a 401k. That's how powerful this is. So if you're ever sued or ever involved with any kind of litigation, you don't have to worry. That money is put away safe and sound. Now here's the real stealth thing. You can create a long-term care policy that has stable pricing. Most long-term care policies are just going up. So as you're getting older, you can't even use the stupid thing. But in this case, if you're diagnosed terminally ill and you need long-term care, you can actually claim the death benefit up to 60 to 70% for yourself, and therefore it becomes a long-term care policy. It's pretty neat. Now, here's why you shouldn't do this. It's too expensive for your budget. If you look at your budget and say, realistically, I can't afford adding that to my budget, don't do it. Or your health is really bad. There's medical underwriting for this. This isn't like some kind of cheap final expense insurance, which is not really in your best interest. You have to medically qualify. So if your health is really bad, and when I mean really bad, I mean like you have diabetic neuropathy. Not just diabetes, but diabetic neuropathy with complications. Also, some people don't care about long-term planning. And even if you have no reason to leave someone money, like you don't care if someone else gets that, you can use it as your way to hedge for your long-term care. It's really vital you can do that. Now, here's something else. There's a thing called budget shock. This applies to mortgages. They call it mortgage shock. It's when you add to a fixed budget a new expense that could be too disruptive. So even if you think it's a really great idea, you have to ask yourself and plan around this if it could be good for you. Because what can look good at the beginning and looks reasonable can be hard over time if you haven't really planned and budgeted around it, especially paying 3-5 years later. But if you can do it, it's a wonderful solution. But one way you can get around that is just to get a smaller policy that's more within your budget. Now, a counter argument is that a whole life is a ripoff. I've heard this many times. It's a ripoff. That's not true. But when you compare it to the cost of term insurance when you're younger and you're 30 years old, you're healthy, and you're getting $1 million policy for $30 a month, you're thinking this sounds like a ripoff. But again, the only thing that matters is what you put into the policy versus what you get back. It's not comparing term when you're young. All you care about is, okay, I invested pennies and nickels to get back dollars. Now, term, as I mentioned, is not an option for retirees. So don't look at some kind of term, because even if they hook you in, you're missing time that you could have had whole life. Look at the money simply as a piggy bank. You put money in, money spits back out. That's all that you have to look for in something that's guaranteed to pay once you finish. That's why I recommend a 10 pay or a 20 pay. But it's very simple. If you can afford it, I recommend it. If you can't, skip it.